What's up, friends? It's Tess. This is Wander Wealthy, and today we're talking about investing. Why you need to invest even if a recession is coming. If you're new to my channel, we talk all about personal finance here. Go ahead and hit the subscribe button so you can be notified. It's over here when I upload new videos, which I do on a weekly basis. Let's get into it. Investing is my favorite subject. I'm going to tell you more about that and why you should continue to follow along at the end of this video. I want to take a second and further explain recessions versus bear markets versus market corrections. So let's start with a correction. It is the smallest kind of downward movement of the stock market. It's when markets drop by 10% from their most recent high. And it often happens because the market's going, whoa, we need to kind of correct ourselves and double check some things and just make sure we're on pace with what is actually happening in the markets. They usually don't last very long. And again, it's one of the smaller ocean moments when it comes to investing because it's only a 10% dip versus a bear market, which is actually a 20% dip from the most recent high. Data shows us that bear markets happen once every about 3.5 years, and they can last for about a year. But let's all get into agreement that the markets historically have always corrected themselves and have also always continued to go up. As long as humans continue to roam this earth and develop new things and you still have to go to work, most likely the stock markets are going to continue to go up. If an apocalypse comes and wipes out the planet, well, we have no need for the markets anyway. All right, so corrections are a 10% drop from the most recent high. They happen about once a year. They're pretty short in time. Bear markets are a 20% drop from the high. They happen once every, let's just say 4 years, and they can last for about a year on average. Now let's talk about the recessions. Recessions happen when there are 2 consecutive quarters, aka 6 months of negative GDP growth. It's actually an economic slowdown, not necessarily a financial market slowdown. But in general, when the economy is slowing down, the financial markets kind of, it takes a toll on them too. Now, overall, it's historically been proven that recessions are pretty hard to predict, and we don't know how often they happen, but we do know that they are inevitable. They've happened in the past, they will continue to happen in the future. So how do you invest knowing that a recession is going to happen? That's what we're going to talk about today. The first thing is, yes, you need to be investing despite the fact that a recession or a bear market or a correction will inevitably happen in your investment lifetime. John Bogle, the founder of Vanguard, has witnessed 3 50% downturns in the market in his investing lifetime. And he said, no, it never feels good, but you need to take emotions out of it. And you need to invest knowing that your strategy is going to work and discipline is going to be your best friend. So knowing that you need to invest despite the fact that something bad will happen, then the idea is that timing the market is not the answer. You can't wait for a good time to get into the stock market. You just have to get in on a regular basis. If you're sitting on the sidelines and waiting for a signal, then you're most likely engaging in active investment management. And we all know from the research and the data that over 90%, and some people will say even more, of active investment managers, whether that's institutional investment managers, people you pay, or yourself trying to buy and sell stocks at the right time, valuing individual companies, these people fail to beat the market's average. And those who take on a passive index investing strategy, well, they tend to produce the average results. Trying to time the market is a part of active investing, and it's just not a prudent strategy. And that leads me to the second thing to consider when you know you're investing during or through or with an impending recession coming, which is to regularly contribute to your investment portfolio. This is called dollar cost averaging. And as you regularly contribute, you should also be considering the rebalancing of your asset allocation. So your portfolio has a specific allocation that you want to be invested in, a certain percentage towards equities and a certain percentage towards fixed income to get to 100% of your portfolio. Let's say you have a 60% equity, aka stocks, and 40% fixed income, aka bonds, asset allocation. If you're investing in a bear market or a bull market where the markets are actually going up, then maybe over time your investments will get out of whack. Well, with your regular contributions, you can consider how much of that contribution are you going to put into equities versus fixed income so you can rebalance it. That's how you regularly contribute and rebalance as you go to maintain your strategy and take emotions out of it. And yes, it's going to feel totally counterintuitive because you're likely going to have to buy into the asset class that isn't doing very well, and you might even have to sell some of your assets that are doing good in order to rebalance your portfolio to the proper allocation for you. But this is the secret sauce behind investing prudently. This allows you to actually and actively sell high and buy low, which we know is kind of that secret to winning the investment game. So regularly contributing and rebalancing your portfolio, despite the fact that there's news of the world ending or a recession coming, or we're in a recession as it is, that will keep you playing the game. And knowing that the market will recover, because over the past 100 plus years, when we have had regular recessions and bear markets, we've also seen recovery. The third thing that is really important to know when you are engaging in an investment strategy, even and especially during a recession or a bear market, or just the market isn't doing very well for you right now, is to know that you only lose when you sell. This is so important because people have such a high fear of losing all of their money if they start investing. They recognize that investing comes with risk and also reward, but that risk scares them a lot because they've seen other people, maybe their parents or their great uncles or their peers, lose money in the investment world. Well, the only reason those people lost money is because they sold when things went bad. And again, it's very unintuitive because we want to make financial decisions based on how we feel, but if we did that, we would be doing so many bad things when it comes to investing. You see, if things are going really well, you're going to want to get into the markets, but if you wait until things go really well, then you're getting in at the height instead of getting in earlier as things start improving. So the people down here got to ride this wave up, whereas you're going to get on top, and yes, it might continue to go up, or it could go down. In that case, you're buying high. You're doing the opposite of what you're supposed to do, which is buy low. And in that same regard, when things go bad, you're gonna feel bad and you're gonna wanna pull all your money out. But if you do that, you're gonna be selling low and you're going to be losing a lot of money. So let's say that you have $1 million and you go through the financial recession, one of many that has happened in the past or will happen in the future. And let's say during this time, the stock market decreases by 50%. Your portfolio of $1 million will have decreased to $500,000, and that might give you a real pit in your stomach. It's no lie. That would suck. But you haven't technically lost money until you sell. If you continue to regularly contribute money based on your asset allocation and rebalance your portfolio as you go, eventually the market will recover and you'll be back up to your level of wealth, if not more. And then you didn't lose any money at all. You just survived that market correction. Plus, you got a ton of shares on sale. I hope everything I'm telling you can calm your nerves about getting invested, despite the fact that there will be bad things that will happen in the market. Now, I must say, a lot of this stuff only works if you take on a passive index investing strategy, which by now you know is the more successful strategy for the average investor and most institutional investors. If you want to learn more about how to start doing passive index investing, figuring out what your asset allocation should be, figuring out what an asset allocation even is in the first place, understanding which type of broker to use, whether it's going with a low-cost brokerage or a robo-advisor, then I have a perfect solution for you. I have a free 10-day Investing 101 bootcamp, 8 emails over the course of 10 days to teach you the basics of passive index investing and help you get started on making your first investment. You can find it at wanderwealthy.com/invest. And I told you earlier that I'd be sharing why investing is such an important topic to me. And that is because I want to help my generation, plus the generations that have gone before me and will come after me, learn the power of investing and really building wealth and passive income through investing. And to share the fact that it's actually way easier than the media, TV shows, news, and a lot of publications have made it out to be. Investing is easy, and I'm gonna share with you how exactly it is easy and let you watch me invest in my upcoming investing course. So get into the free investing bootcamp, because then you will be on the list to learn about my investing course that will be coming very, very soon. Make sure to like this video if you did, and subscribe to my channel so you can stay in tune with what's necessary in the investment world. And until next time, I hope you wander wealthy.